What's up guys, John here. I'm a certified public accountant who loves to teach. So the most common question I get from my younger clients in regards to investing is, what stock should I buy? Although it is a simple question, but it is an attempt to shortcut a process. Investing is a process. It boils down to 4 major steps. The first one is to set your goal. The second step is to determine how much to save for your goal. The third one is to determine your asset allocations. And the fourth, final step is to select investments for the asset allocation. So you see, picking what to invest, picking individual stock, it's actually the last step. You want to set your goal first. All right, so please watch the video until the end so you will know what investment is appropriate for your asset allocation. So let's see the first step, setting your goal. Your goal should be attainable, specific, and time-based. Many people, I ask them, what's your investment goal? They told me something very vague and generic. For example, they will usually tell me, I want to retire early and I want to travel around the world. So what do you do when you have a goal like that? Do you save $10,000 a year? How much do you need for retiring early? Do you need $1 million, $3 million? How much do you need to save per month? So this kind of goal is too generic. You actually don't know what to do. So a good example of a good goal is something like this. I want to save up $50,000 by August 2025. So that's in 5 years, right? So I can put a 20% down payment for my first dream home. And the house that I want to buy is priced around $250,000. So that's a very attainable, specific, and time-based goal. So you know exactly what to do. So having a good goal will set the foundation for the rest of your investing process. So the second step is determining how much to save for your goal. So for simple calculation, let's ignore the concept of time value of money and let's just use simple math. So what you do is the total amount you want to save and divide the number of years. So my example above, right? Buying the first dream home, I want to save $50,000. That the goal is to have that $50,000 in 5 years. So how much do I have to save? I do 50,000 divided by 5. So that's 10,000 a year. 10,000 a year divided by 12 months. That comes up to 834 a month. So now I know what to do. I will do as much as I can. Looking over my budget, make sure I don't spend on nonsense because my goal is to save 834 by the end of the month. So I know exactly what to do now. That's setting a good goal. The third step is something called asset allocation. Asset allocation refers to the strategy of dividing your investment among different asset categories, such as stocks, bonds, and cash. It aims to balance the risk and reward by allocating your portfolio asset according to your goal, risk tolerance, and time horizon. So I'll give you a quick example. Say if you are a conservative investor and your time horizon for your goal is 3 to 5 years, so an appropriate asset allocation for you will be 40, 50, 10. 40% you can invest in stock funds. 50% in kind of fixed income is called bonds. Then the last 10% in cash. If you divide your investment in this kind of percentage, you make sure it balances out because your goal is only in 3 to 5 years, which is very soon. You don't want the value of your investment to go up and down too much. Because when the 3-year time comes and you need to buy, let's say your goal is to have a down payment, buy your house, Oops, all of a sudden the stock market crashed. You can't sell that. You don't want to sell your stock when the stock market is crashing. So what do? You have to wait. But who is to say the stock will rebound in 1 year? Sometimes it takes 5 years, depending on how severe the stock market crashes. So you want to invest in something. When this allocation, 50% go into bond, which is a more conservative type of investment, it will make sure the balance and your investment value stable. It doesn't fluctuate too much. So another example, if you are a more aggressive investor and your time horizon for your goal is 15 years, that's a long time, right? Then an appropriate asset allocation for you will be 90-5-5. You could risk 90% of your investment in stock, 5% in bonds, and put 5% in cash. Because 15 years, you usually will go through about 2 to 3 economic cycle. You will go up and down, right? Stock market always go up and down. It gives you enough time to rebound and grow. That's why an appropriate amount will be 90% in stocks and give you the opportunity to grow. So why is asset allocation so important? You're even doing it way before you pick stock. Because many investment research conclude that the number one factor that affects your investment return is asset allocation. The second factor would be the selection of the individual stock or bonds. Therefore, you should spend more time thinking about asset allocation rather than spend all your time in deciding what stock to buy. Because having a sound asset allocation will make sure your investment picking is aligned with your goal. All right, so you should use different asset allocation for different goals, like we mentioned before. Example, if you're saving a $20,000 for a new car next year, you should invest in something very safe, like money market fund. 2 years is not a long time, or next year is not a long time. So you want to make sure the value stays stable. Another example, if you're saving for your retirement in 30 years, that sounds like eternity, right? Forever. You can allocate your portfolio to be 90% stock and 10% bonds. So the fourth step we talk about in the investment process is select investment for your asset allocation. So now this is where most people are asking, what stock should I buy? So when you are a beginner for investing, I recommend you to start with an index fund. An index fund is a type of mutual fund or exchange-traded fund with the portfolio constructed to match the component of a stock market index, such as Dow Jones, S&P 500. Your money is invested, let's say if you invest in the S&P 500 index fund, your money is invested in 500 largest company in the US. So that's very well diversified, right? By just buying or invest in a single fund. So I will give you an example. A big stock fund, an index fund will be S&P 500. The ticker symbol is SPY. So you could look it up using Yahoo Finance and you could type in SPY. This is a exchange-traded fund that invests in S&P 500. If you are into bonds, then another ticker symbol is called AGG. AGG like George, AGG. This is tracking the US aggregate bond. The performance will mirror the aggregate bond. It is an ETF. Okay, I hope you learned something from this video and I would like to get some feedback from you. Please comment below. Let me know what's your financial goal and let me know what investment you choose. What's your asset allocation if you want to share with us. I also do private financial consultations. For any inquiry, my email can be found below in the description sections. If you like this video, please give me a like and subscribe to my channel. My channel is about personal finance, and I drop 2 new content every week, and I don't want you to miss it. All right, and let me know what other topic you want me to cover. Let me know. Thanks for watching.